Very good morning, friends. So, I hope you're all safe and healthy. Well, I would be starting with Ind AS 36 today, and that deals with impairment of assets. When I look at the name of the standard, impairment of asset, what comes to my mind is what is impairment and which assets are we covering under the purview of Ind AS 36. Actually, there are two standards which are dealing with the concept of impairment. One is Ind AS 109, which also talks about the impairment of financial assets. If you look at the balance sheet of a company as per Schedule 3, I would say that there are two kind of assets. One is what we call financial assets, and the other is what we call non-financial assets. Well, per se, I would say that all the impairment of financial assets is covered by 109 and non-financial assets is covered under Ind AS 36. But it's not exactly true. Before I start with this Ind AS 36, I think the first thing we need to understand is that, what is impairment? So I think first of all, let's understand that what is impairment. Then I am going to give you a five-step model in terms of application of Ind AS 36. So you mean to say that just like Ind AS 115, there is a five-step model in terms of Ind AS 36? No, there is not. This is only my own creation in terms of understanding Ind AS 36. Please don't mention that in the exam that Ind AS 36 is based on a five-step model. It is just for the ease of understanding that I've made my own five-step model in terms of applying Ind AS 36. So in this particular case, I think what I need to first elaborate to you is what is impairment. So I think let's understand first of all what is impairment. So let me take an example to illustrate the concept of what is impairment. Imagine a company has got a machine. So let's say the machine has got a book value, let's say to the extent of 20 lakhs. Now I'm going to put two extreme questions to myself that if I sell this machine right away, what do I get? So let's say if I say that I sell the machine right now, then let's say I'm going to fetch 18 lakhs. Or on the other hand, let's consider another extreme and let's imagine that if I were to use this machine for the next, let's say 5 years. So from the use of the machine, I'm going to generate some future inflows. And since the inflows will be generated in the future, let's consider the time value of money and let's consider the present value of all those future inflow. So let's say the present value of all that works out at 19 lakhs. So we're looking at the two extreme situation that if I sell the machine right away, what do I get? And if I use the machine for the next 5 years, then the present value of all the future inflow works out at 90. We can say that what can you recover from the machine? Looking at the two alternatives, the best alternative is that you use the machine. So we can say that we can at the max recover a total of 19 lakhs from the machine. Even by looking at the two extremes that you could sell the machine or you could use the machine, the maximum amount which you could recover is to the extent of 19. But the book value of the machine is 20 lakhs, which means the asset is overstated in the books of account. And this is what we technically call impairment. That means when the carrying amount of the asset exceeds what you can recover from the asset, that means this difference of 1 lakh rupees is supposed to be an impairment. I think let me put this now a little more technical way. The purpose of holding a machine is never to sell. If you look at the definition of a property, plant, equipment, it very clearly says that it is held for use in production. So in ordinary circumstances, when you're looking at a machine, you are planning to use the machine in a future period of time. But Ind AS 36 says that in order to visualize what you can recover from the machine, you look at two different extremes. On one hand, you consider that if I were to sell the machine, what do I get? And the other hand, if you were to use the machine, what do you get? So what can you recover from the two extremes, that is use or sale? So they've given some technical wordings, like when I say that if you sell the machine, they call this as what we say it's a fair value less the cost of disposal. We call it as FVLCD. That's a fair value less the cost of disposal. That means if you were to sell the asset today, then after considering the cost of disposal, what is the net fair value you would receive? And they say that if you use the asset, then you're going to generate some future inflows. And if you discount them, then this use is technically called a VIUs. It is called a VIU, that's a value in use. So VIU is called a value in use. So they say that you calculate the two extremes. Consider on one hand that if you continue to use the machine for a future period of time, then what is the inflows, the discounted value of those inflow? And on the other hand, if you exit and sell the asset, what do you get? So the comparison of the two is what we get. 19 lakhs is technically called a recoverable amount. So what you can recover from use or what you can recover from the sale of the asset, that's called a recoverable amount. The recoverable amount is supposed to be the higher of the two. So you're looking at two extreme situations and you're looking at the better of the two alternatives, that whether we sell or whether we use the machine and we get a recoverable amount. This 20 lakhs is what we call the book value or what we call the carrying amount. And if the carrying amount exceeds the recoverable amount, it is called impairment. This standard indirectly ensures that the asset is never carried in the books of accounts at more than what you can recover from use or sale. If the carrying amount of the asset is more than the recoverable amount, it indicates that it is impaired. It is overstated in the books of accounts, and this 1 lakh rupees is what we technically call an impairment loss. But we don't calculate the impairment loss every year. We need to make a formal estimation of the recoverable amount only when there are indicators of impairment. So there is going to be a chronological order in which we're going to approach the testing of impairment of an asset. I would say, impairment is like a disease, and we like financial doctors would look into that there's symptoms of a disease, and accordingly we would evaluate, whether there is a need to make an estimation of a recoverable amount or not. Well, I think to put all this in a little crux, if somebody were to, ask me mathematically what is impairment, so I would say that if I were to calculate an impairment loss, I would say impairment loss is when the carrying amount or the book value of the asset is more than the recoverable amount of the asset. But if it is the other way around, the carrying amount is less as compared to the recoverable amount, there is no impairment. So it is only when the carrying amount is more than the recoverable amount. And if somebody were to say that what is a recoverable amount, I would say it is the higher of the two. I would say it is the higher of the two. And what is the two values? One is what we call the fair value less the cost of disposal. We call it as FELCD. And the second is what we said, it's a VIU, that's a value in use, which is a present value. The VIU is based on the present value of the future cash flows. So when you're going to use the asset, from the continuing use of the asset, you're going to get some cash inflows. The present value of those inflows, including the scrap value, is going to be called as a VIU. So I think we've understood that what is impairment. Now, before I take the journey forward, as I said, I have created my own 5-step model. I'll call it as a KB's 5-step model in terms of applying Ind AS 36 in a practical life situation and even from an examination point of view. I again tell you that this 5-step model is not what the Ind AS has given us. This is something which I have created on my own. So, in terms of the five-step model, I'll tell you how you would proceed. Number one, the step number one. The first thing is that you need to look at the scope of this Ind AS. Now, just to give you a little brief in terms of each step along, I would say that there are basically three categories of assets. For the purpose of impairment, I would say that there are three categories of asset. One is, you can say, the financial assets. One is, you can say, there are non-financial assets. And one is, I would say that there is an inbuilt impairment testing. There is an inbuilt impairment testing which is built in the measurement principle of those Ind AS. So we didn't get that. What is that inbuilt impairment? I'll tell you. When you're looking at impairment of financial assets, we are looking at Ind AS 109. Per se, the financial assets are covered under Ind AS 109, and per se, the impairment of the non-financial assets is covered under Ind AS 36. But I'm now also going to take you to the scope of the Ind AS, where you would see that there are certain assets which are not required to be tested for impairment. Like, for example, if not to go far, imagine when you look at inventory, inventory is taken at cost or NRV, whichever is less. What are you indirectly ensuring? You ensure that the inventory should not be carried at more than what you can recover. The NRV is nothing but it is based on the sale of the inventory. But indirectly, when you say that inventory is taken at cost or NRV, whichever is less, it is indirectly ensuring that the inventory is never carried in the balance sheet at more than what can be recovered from the sale of the inventory. Recoverable amount is based on, as per Ind AS 36, on the two extremes of use and sale. But inventories are meant for sale. So the net realizable value takes into account the purpose, which is the sale. So in this particular case, there are many standards where there is inbuilt impairment. Like I said, Ind AS 2, it has got an inbuilt impairment testing, even like Ind AS 12. And there are plethora of them. I think we'll discuss those things. We'll discuss Ind AS 12 as well, where DTA is supposed to be carried forward only to the extent that, future taxable incomes would arise. But trust me, if you were to go back and look at the balance sheet in terms of Schedule 3 Division 2, you would see that every asset falls in these three categories. Either the impairment is covered under 36 or it is covered under 109, or there is some inbuilt measurement principle, which ensures that the asset is never carried at more than what you could recover from the use or the sale of the asset. So none of the assets would ever get overstated. So impairment indirectly, takes care of the fact that none of the assets would ever get reflected in the books of accounts at more than the recoverable amount. So none of the assets would ever get overstated. And the perspective, the objective of drafting a balance sheet is that the asset should never get overstated, liability should never get understated. Well, we are looking at impairment of assets, so I'm not looking in terms of liability. The focus is purely in terms of asset. So I would say the step number one is that you need to first of all see that is this asset, is the impairment of this asset within the scope of this Ind AS or not? So per se, as I said, it is only the non-financial assets which are within the purview of this Ind AS. Now, once you decide that yes, this particular non-financial asset is within the purview of Ind AS 36, the next stage is looking at the indicators of impairment. The next stage is looking at the indicators of impairment. As I said a few minutes back, that impairment is like a disease. Because the asset is overstated in the balance sheet. So it's not that I'll start making a calculation of the recoverable amount at the end of each year. There has to be some symptoms of the disease, and that's called the indicators of impairment. It is only when the indicators of impairment is present, then I would do an impairment testing. Then there is a step number three, and step number three means that once the indicators are present, so you're going in a chronological order, you would see that is this asset within the purview of 36? Yes. Are they indicators of impairment? Yes. Then what do? You would make a calculation of the recoverable amount. A formal estimation of the recoverable amount will be done only when indicators are present. And then you would start doing the accounting of that impairment loss. So once you know that yes, the recoverable amount is lesser compared to the book value, then there is an accounting required for the impairment loss. Now, in terms of accounting, Ind AS 36 has done a beautiful thing. What they've done, you can segregate the entire accounting in terms of two sections. And you can say one is that if you're carrying on the impairment for an individual asset, or are you doing an impairment testing for a group of assets? So I would say before the accounting, we need to zero down also on this fact that is the impairment testing to be done for a standalone asset, or is it to be done for a group of assets put together, what we technically call a CGU. That's called a cash generating unit. So in terms of accounting, we will first, do case studies in terms of how to decide, is the accounting to be done, is the impairment testing to be done for individual, or is it to be done for a group of assets? There is a specific accounting given that if the impairment is done for the individual asset, how do you account for it? And when it comes to a group of assets, in the group of assets, there is now also going to be some special issues. The moment you are going to do impairment testing for a group of assets, there will be certain special issues which will crop in your mind. And there are two special issues which we need to deal with when you're looking at impairment for a group of assets. One is called goodwill. That is the goodwill which arose on a business combination. When a company acquired another company and Ind AS 103 was applicable, it was a business combination, then the goodwill which arose at the time of acquisition accounting, which is in the balance sheet of the company. So we need to take care of the special agenda. How would you take care of impairment testing of goodwill? Now, how does it get taken care? That is something we'll see later. Then there is another agenda, and that is in terms of what we call the corporate assets. Then there is another agenda, and that is what you call the corporate assets. So we need to tackle the two special issues in terms of things. So one is we are looking in terms of goodwill as a special issue, and one is we are looking in terms of corporate assets as a special issue. So when you're looking at the impairment testing would be done in terms of either an individual asset or in terms of a group of assets. And in terms of group of assets, we'll get the special issues, goodwill, as well as the corporate assets. And let me also now go to the next step with you. So this is just a chain of thought, which I am trying to put into your mind. So once you book an impairment loss, maybe in a subsequent year, the impairment indicators might take a U-turn. So if the impairment indicators take a U-turn, then there is a possibility for going in for a reversal of impairment loss. That is only when the indicators have taken a U-turn, then impairment loss was booked in a particular year, and then in a subsequent year, you will have to go in for a reversal. And finally, the standard deals with the concept of disclosures. Though from an examination point of view, I'm not too connected with the concept of disclosure. To me, effectively, it's more like a 4-step procedure from an examination point of view. So I think let's just have a quick run through in terms of the 5-step model. So what you understood so far is two things. One is we've understood that what is impairment. So we said in terms of impairment, you need to compare the carrying amount or the book value of the asset versus the recoverable amount. The recoverable amount considers the two extremes, that if you sell the asset, what do you get? If you use the asset, what do you get? So you look at the better of the two alternatives. So if you cannot recover, the recoverable amount is less as compared to carrying amount, it's impaired. because then the asset is overstated in the books of accounts, because looking at the two extremes also, the maximum amount you can recover is below the carrying amount. So that is what is impairment. And then I said, when you're looking at impairment, there are two standards in the Ind AS. One is Ind AS 36 and one is Ind AS 109, which looks into the impairment testing. So I created a total 5-step model. Today I'm going to work on the step number 1 and on the step number 2. In terms of step number 1, you need to first of all zero down that is the asset within the scope of this Ind AS. There are three kinds of assets. One is what we said, financial assets. One is what we call non-financial assets. And then there are certain assets where the impairment testing is not required because the measurement principles of those Ind AS takes care of the impairment testing. So if it is a financial asset, it is within the scope of 109. If it is non-financial, it is within the scope of 36. But then for those particular assets which have got inbuilt impairment testing, within the measurement principles applicable to those Ind AS, we don't need to conduct any impairment testing. Once you say that yes, this asset is within the scope of this Ind AS, then you look at the symptoms, the indicators. Once there is an indicator, you make a calculation of the recoverable amount, and it involves accounting for the impairment loss, where we need to see whether impairment is being done for a single asset individual or is it for a group of assets. When we're going to do impairment testing for a group of assets, you're going to confront two special issues. One is goodwill and one is the corporate assets. And then I said that if there is a possibility that later in subsequent years, the indicators of impairment have taken a U-turn, so there could be a reversal of impairment. And finally, the disclosures. That is what I call the 5-step model, my own 5-step model in terms of Ind AS 36. I think now what I need to do in this particular case, I need to now consider the aspect in terms of understanding the scope of this Ind AS. So let's do one thing. I think, first of all, take you to the text of the standard. And I think let's read the objective as well, because I think a fair reading on the objective would also, just endorse the learnings, what we have done. And then I think I'll formally take you to the scope of this Ind AS as well. If you look at the objective of this Ind AS, it says the objective is to prescribe the procedure that entity applies to ensure that assets are carried at no more than the recoverable amount. An asset is carried at more than the recoverable amount if its carrying amount exceeds the amount to be recovered through use or sale. You can get the connect. It says an asset is carried at more than the recoverable amount if the carrying amount exceeds the amount to be recovered through use or sale, two extremes. If this is the case, the asset is described as impaired and the standard requires the entity to recognize an impairment loss. The standard also specifies when entity would reverse the impairment loss, that becomes a step number 4, and the disclosure, that becomes the step number 5. So I just read the objective, just to connect in terms of what we've learned. Now, coming to the step number 1, my focus is now in terms of the step number 1. It says this standard is applied in accounting for impairment of all assets. The word is all assets, but we need to see that it would definitely not include two kinds of assets. One is the financial assets, and one is those assets where there is an inbuilt impairment testing. Look at the point number A. He gives you the exceptions that Ind AS 36 does not apply to assets. A, inventory. Now, in terms of inventory, one can very clearly say in terms of inventory that it is taken at cost or NRV, whichever is less. It takes care of impairment testing. Then there is a contract assets and assets which arise from the cost to obtain a contract or to fulfill a contract. If you remember what we did in Ind AS 115, We did a couple of cases where the cost to obtain and the cost to fulfill the contract is considered as a capitalized cost. Those assets impairment is covered under Ind AS 109. So these contract assets which are arising by virtue of Ind AS 115 are not covered under this standard because they are covered under Ind AS 109. Then it says point number C, DTA. Ind AS 12 ensures that deferred tax asset can be recognized only when it is probable that future taxable income would arise. So we call that as a concept of prudence, where you need to make a review of the reasonable certainty that future taxable incomes would arise. So in this particular case, that cross check of the reasonable certainty whether future incomes would arise or not, rather I would use the word future taxable income arises or not, indirectly takes care that if the asset is impaired, you write off, you reverse the DTA to that extent. So there is an inbuilt impairment testing. Then he says assets arising from employee benefits. Under Ind AS 19, there are assets called plan assets. And these plan assets are carried at a fair value by virtue of Ind AS 19. So when they're carried at a fair value, then impairment testing is not required. So do you mean to say that those assets which are taken at a fair value, in those cases, impairment testing would not be required? I didn't say that. But yes, indirectly I said that. But let me tell you, many people think that if there is, let's say, a property, plant, equipment, or let's say there is an intangible assets which is recorded using a revaluation model under Ind AS 16 or 38, that impairment would not apply to those particular assets. Let me tell you, no, it's not true. Ind AS 36, gives us a clarification also that when you're looking in terms of even the revalued assets, which are carried at a revaluation model under Ind AS 16 or 38, you would be covered by Ind AS 36. So, but then they are carried at a fair value. Then why should impairment testing apply? Don't worry, we'll discuss that issue also very shortly. Then he talks about very clearly in point E, financial assets. As I said, that all the financial assets impairment is covered under 109. So you can see that point B and point E, are covered under 109. So, but is point B also a financial asset? Well, there has been a question in the education material under Ind AS, that was in Ind AS 115, where the institute also tried to answer that is that contract asset supposed to be a financial asset or not? And in this particular cases, you need to prove the concept whether it is a contractual right or not. I think let me not get into that. I think otherwise we'll deviate from the issue. We've discussed that issue at length in terms of 115 also. I showed you that question in the book also. But I can say if you zero down in the scope, you can say B and E is covered by 109. And then A, C, D, there is an inbuilt impairment testing. That's how I can connect. Let's see further. Then there are some more assets, where the inbuilt impairment testing is there. Look at the point number G. Biological assets related to agricultural activity are covered under Ind AS 41. So we're not talking about the bearer plant, mind you. When you're looking at the biological assets, we know that there are two kinds of biological assets. One is a bearer plant covered under Ind AS 16. To that, impairment is applicable. But for those biological assets other than bearer plant which are covered under Ind AS 41, they are not covered under impairment because they are already measured at a net fair value, which is a fair value less cost to sell as good as fair value less cost of disposal. Now here is the connect which you can see. The revalued assets, when you consider a PPE or when you consider intangible assets under a revaluation model, they are recorded at a fair value. They are not recorded at a fair value less cost to sell. But when you calculate a recoverable amount, it considers the fair value less cost of disposal. So since the recoverable amount is based on a net fair value, but the asset in terms of Ind AS 16 or Ind AS 38 is carried at a fair value, which is not a net value, which is not the net cost of disposal. So naturally there could be, impairment testing. Don't worry, we'll take some figures to elaborate it further. I'm not concerned with H because 104 Ind AS is not in the course. And then there is another asset which has got inbuilt impairment testing. NCA, non-current assets held for sale. Ind AS 105 prescribes that if there is a non-current assets which is classified as held for sale, they are measured at the lower of the carrying amount or the fair value less the cost to sell. So the automatically impairment testing is inbuilt in the measurement principle. So one needs to be very clear in terms of, that which asset is covered under 109, which asset is covered under 36, and where there is an inbuilt impairment testing and that would not be covered. I think let's make some notes on this. And I think I'll make my discussion on the aspect of revaluation assets also in this particular concept. So this is like my step number 1. So I am now making the notes on my 5-step model. So I'm working on the step number 1. Now, in terms of step number 1, we said we're going to look at the scope of the Ind AS. So we said let's categorize the assets in 3. If you're looking in terms of financial assets, if you're looking in terms of non-financial assets, and are you looking in terms of those assets where there is inbuilt impairment testing? So those assets which have got inbuilt impairment testing, the measurement principles take care of the fact. Now, let me also give you something more interesting in terms of para number 4, because I think without this, we will not get that edge level of clarity. I said financial assets impairment is covered under Ind AS 109. But it's not true that all financial assets impairment will be covered under 109. Now, let me give you a little technical input at this stage. If you see the scope of Ind AS 32 and the scope of Ind AS 109, it scopes out investment in a subsidiary, investment in a JV, and investment in an associate. All investments are financial assets. But Ind AS 32 and 109 scopes out the investment in a subsidiary, associate, and a JV outside the purview of financial instrument standard. Then these investments will be covered under which standard? Ind AS 27. Now, what does Ind AS 27 tells me? Ind AS 27 says that these investments are to be carried at cost or fair value. You've got a choice. If these investments are carried at cost as per Ind AS 27, then the impairment testing is applicable and it is covered under Ind AS 36. And if you're looking in terms of that these investments are carried at a fair value, then Ind AS 109 applies. And as per Ind AS 109, these investments will be taken at a fair value through other comprehensive income with a no recycling. And Ind AS 109 is not applicable to those financial assets which are carried at a fair value through OCI non-recycling. So good God, can you put that again? This was a little technical one. I said that if you've got investments in subsidiary, associate, and JV, 32109 is not applicable per se. You apply Ind AS 27. Ind AS 27 says that you can measure these investments at cost or at a fair value. If you measure them at a cost, then impairment testing is done under Ind AS 36. If these are measured at a fair value, then Ind AS 109 applies and the fair value is FVTOCI. And since it is an equity investment, it is FPTOCI with no recycling. Impairment testing does not apply to financial assets measured at FPTOCI non-recycling. Very interesting input. So I think let me also put that along in this particular chart. So as I said, that if you're looking in terms of financial assets, I think to give you a more deeper inputs, I would say there are two kinds of financial assets. One is we can say the investment in a subsidiary or investment in a joint venture or investment in an associate. And we're looking at other financial assets, or we're looking at other financial assets. Now, when you say it is investment in a subsidiary, associate, or JV, then in this particular case, we can say that in this case, what happens that Ind AS 27 applies. Ind AS 27 deals with separate financial statements. So these investments are recorded in the separate financial statements of the investor applying Ind AS 27. So Ind AS 27 says that they can be measured either at cost or they can be measured either at a fair value. Now, if these investments are taken at cost, then we test them for impairment, and the impairment is covered. The impairment is covered under Ind AS 36, not 109, though it is a financial asset. But the impairment testing of this financial asset is covered under Ind AS 36. And if it is taken at a fair value, then in this particular case, they are measured at a fair value through other comprehensive income without any recycling. So there is no recycling. So impairment testing is not applicable. Impairment concept is not applicable because Ind AS 109 scopes out the financial assets measured at OCI with a no recycling. Now, if I look at the other financial assets, I can say for other financial assets, the impairment testing is covered under Ind AS 109. In terms of non-financial assets, we are again covered by Ind AS 36. Sir, and a clarification with regard to the revalued assets. So also let me put it out here as a clarification out here. As a clarification, let me also put something out here that the clarification in this case is that if you've got a PPE which is measured, if there is a property plant equipment which is measured using a revaluation model as per Ind AS 30, as per Ind AS 16. So if you've got let's say a property plant equipment which is measured using a revaluation model, or let's say you've got for example an intangible asset which is measured using a revaluation model, which is measured using a revaluation model as per Ind AS 38, as per Ind AS 38. In this cases also Ind AS 36 applies. So whether it's a PPE or whether it's intangible assets which is taken at a revaluation model, then also Ind AS 36 applies. Let me also give you a little insight further with regard to these assets which are taken at a fair value. We need to first of all zero down on one very simple little concept, and that is that as per Ind AS 16 or as per Ind AS 38, the book value or the carrying amount or the fair value, if you've taken them at a recoverable at a fair value, so the book value, the carrying amount, and the fair value is same. But when you calculate a recoverable amount, the recoverable amount is supposed to be the higher of the two values, which is a fair value less the cost of disposal and the VIU. Now just imagine a few figures to get the concept clear. Just assume for a moment that the cost of disposal is negligible. If the cost of disposal is negligible, can I say the book value or the fair value is equal to, let's say, 10 lakh? and the fair value less cost of disposal is also 10? Because if the cost of disposal is negligible, then the fair value and the net fair value is same. Now, the VIU is, let's say, 11, or the VIU is, let's say, 9. One thing is pretty clear, that recoverable amount would be at least 10. Because if your VIU is 11, the recoverable amount is 11. If the VIU is 9, the recoverable amount is 10. So one can definitely say one thing, that if the cost of disposal is negligible, it's not cash on delivery, it's a cost of disposal. So if the cost of disposal is negligible, then you can certainly say that the recoverable amount will be at least equal to or greater than, you can say, the fair value, or you can say the book value, or the carrying amount. So there can be no impairment. There can be no impairment in this particular case. You will not find any impairment taking place, because the recoverable amount will be equal to or greater than the fair value of the asset, so there cannot be impairment. But if the cost of disposal is not negligible, then the book value is 10, and let's say the cost of disposal is, let's say, 20,000, then this would become 9.8. In that particular case, if the VIU is 9, the recoverable amount becomes 9.8. Then there can be impairment. So if the cost of disposal is not negligible, there can be impairment, but impairment would not exceed the COD. That is also pretty clear. The impairment would never exceed the COD. So you can say if the cash on delivery is negligible or it is not negligible. So if you say it is negligible, then there is no question of impairment. But if it is not negligible, then the recoverable amount may be greater compared to the carrying amount, or maybe less. So there may be impairment. There may be impairment. But one thing is sure, that there may be impairment, but that impairment would never exceed the cost of disposal. So even in this case, impairment is there. One thing is very clear, that impairment loss would be less than equal to the cost of disposal for sure. So that is the reason, that Ind AS 36 also brings into account the assets which are carried at a revaluation model. They are also under the purview of Ind AS 36. Now this is, all is going to give you a huge level of clarity in terms of things. Now the third area of the assets is where there is an inbuilt impairment testing. And I think if I'm looking in terms of inbuilt impairment testing, you've got inventory. And in terms of inventory, you know that there is an inbuilt impairment testing, that is Ind AS 2. You know that there is a DTA, there is an inbuilt impairment testing under Ind AS 12. Every time you need to ensure that future taxable income will be generated. And then we are also looking in terms of the plan assets under Ind AS 19. And in terms of the plan assets, Ind AS 19 takes care that they are carried at a fair value. So there is an inbuilt impairment testing for the planned assets. Then we also saw that there might be biological assets. There might be biological assets, but other than bearer plant. We're looking at biological assets other than the bearer plant, because bearer plant is covered under Ind AS 16. So to them, impairment testing is going to be applicable. So it is only those biological assets which are measured at fair value less cost to sell are covered under Ind AS 41. So their impairment testing is inbuilt. And then there is non-current assets held for sale. We saw that as per Ind AS 105, these assets are taken at the lower of the carrying amount and the fair value less cost to sell. So for all these assets, impairment testing is not required because there is inbuilt impairment testing. So I think I've given you a complete input in terms of, looking at the first stage, that is the asset you're looking at, is it within the scope of this Ind AS? So per se, we can say that all the non-financial assets, irrespective they are carried at a fair value or they're carried at a revaluation model rather than fair value, or at a cost model, and certain financial assets are within the purview of this Ind AS. Now, once you cover them in this Ind AS, we need to do impairment testing only when the indicators of impairment. So my step number one gets done. I think now let's go to the step number two. So this will give you a good level of clarity in terms of the approach of Ind AS 36. Now, as I said, the step number two, the step number two in terms of impairment testing is, looking at the indicators, of impairment. As I said, there has to be a symptom. We're not going to test an asset or a group of assets for impairment unless there are indicators of the disease. But let me make one thing very clear. There are certain exceptions in Ind AS 36 where impairment testing would be done even if there are no indicators of impairment. So I would say there are two situations. One is that impairment testing is done when there are indicators. Another is that even if there are no indicators, we still need to do impairment testing. Let's, I think, take you to the text once again and have a look at the indicators of impairment. Look at the para number 9 and the para number 10. It says entity shall assess at the end of each reporting period whether there is any indication that asset may be impaired. If any such indication exists, the entity shall estimate the recoverable amount. So para number 9 makes it very clear that entity will assess at the end of each balance sheet date whether there is any indication, if any such indication exists. It is only then we make a formal estimation of the recoverable amount. But para number 10 makes it very clear that there are certain exceptions. Irrespective whether there is any indication of impairment, entity shall, number one, test an intangible asset with an indefinite useful life, or an intangible asset not yet available for use, for impairment annually. Well, if you remember, in terms of Ind AS 38, there are certain intangible assets which are not annually amortized because they've got an indefinite life. It's not infinite, it is indefinite. So these assets are tested for impairment annually. Even those intangible assets which are being developed, which are in the development phase and they're not yet available for use. If you recall, in terms of Ind AS 38, we test them every year that the amount of expenditure incurred on the development phase does not exceed the recoverable amount. So for the assets which are not yet available for use, or those intangible assets with an indefinite life, they are tested for impairment every year, even if there are no indicators of impairment. I'm not reading further from the examination perspective. And the second exception is in terms of goodwill. Goodwill which arises on a business combination is also tested for impairment annually, unlike the IGAP earlier, where goodwill was tested, was amortized every year. Now goodwill is not amortized. Goodwill is tested for impairment every year. These are the only two exceptions. So I think before I pen this down, I think let's go through now the indicators of impairment. So we said that there are two kinds of assets. One is exception goodwill. One is exception in terms of intangible assets with an indefinite life or which are not available for use. They are tested for impairment every year. Now we're looking at those assets where indicators are required. What are the indicators for impairment? Now, in terms of impairment, there are some external sources and there are some internal sources. So let's, I think, concentrate only on the external sources from an examination perspective. Number 1A. It says there are observable indication that the asset's value has declined during the period significantly more than is expected as a result of passage of time. Depreciation is charged for the passage of time. Depreciation takes care of the fact that there is a decline in the value of the asset due to a passage of time. But even if once you're considering depreciation, you're reducing the value of the asset every year, but still the book value is exceeding the recoverable amount. That means your depreciation is indirectly capable of taking care of the impairment aspects. So I would put it like this in terms of A, that if the asset value falls down, it is the fair value which goes down. And I think you can look at it mathematically that if the fair value of the asset goes down, fair value is one of the components of recoverable amount that goes down. So there would be impairment. The second condition is significant changes with an adverse effect have taken place during the period or will take place in the near future in the technological, market, economic, or the legal environment. So any changes in terms of technology, in terms of market, economic, legal environment is collectively called a business environment. So any change in the business environment which is going to have an adverse effect on the entity will impact the cash flows. And the VIU, which is one of the components of the recoverable amount, if the cash flow goes down, naturally the recoverable amount will go down. So indirectly we're saying that the business environment could impact the cash flows. Then in terms of C, he tells you that the market interest rates or the rate of returns in the markets have increased. When you consider a VIU, you need to consider a present value of the future inflows. Now, when you consider the present value, you need a discount rate. So if the interest rate goes up, higher the discounting rate, lower the present value. So increasing interest rates on the investments would mean that you're using a higher discounting rate, the present value will go down. So it says those increases will affect the discount rate and it'll decrease the recoverable amount materially. So the first three factors you can see, some way or the other, they're connected to the recoverable amount. The first factor is in terms of decline in the fair value is a direct hit on the recoverable amount. The second is the changes in the business environment has a direct impact on the cash flows. The VIU goes down. The third is the discount rate. The market rate of interest would mean the discount rate pushes up the present value, the VIU goes down. And then there is something very interesting in terms of clause D, which says the carrying amount of the net assets is more than the market capitalization. That means the net assets in the balance sheet of the company exceeds the market capitalization. If you multiply the number of shares into the market price per share, that's the market capitalization of the company. If the net assets in the balance sheet is more than the market capitalization, it means the net assets are overstated in the books of accounts. So though there are no questions on the area, which I've covered so far, there have been no questions in the exam on step 1 as well as in terms of step 2. But I think still we'll pen it down because, this understanding is very important. Because, when you go to attack a particular standard, imagine, what we have done wrong. What we have done right now is we have just been trying to understand the concept of impairment of assets, which assets and what is impairment. We should be able to understand the larger perspective in terms of the words impairment of assets. So you're now clear what is impairment. You should be clear in terms of which assets, which is based on my step number 1. And do we do impairment testing every year? It is only when indicators are present, with the exceptions of goodwill and intangible assets. Let's, I think, pen this down. So I would put it like this, that indicators of impairment. So I would say there are two cases. We can say there is a case number 1 where impairment testing is done only. Impairment testing is done only, impairment testing is done only when indicators are present. When indicators are present. And then we said there is a case number two, which is like exceptions. The case number two is like exceptions, where we said impairment is done annually. Impairment testing is done annually, irrespective. So testing is done annually, even if there are no indicators for impairment, we will still do the impairment testing. Now let's, I think, take down what are the two exceptions. The first exception is in terms of goodwill. The second exception is in terms of intangible assets. One is intangible assets with indefinite life. One is an intangible asset with indefinite life, and the other intangible asset is which is not yet ready for use. So that is intangible assets which is still under a development phase. The company is still developing that intangible assets internally. So impairment testing is done when indicators are present. So let's see what are the indicators. So we can say in terms of indicators, I don't want to put any thesis, but just the key inputs would do that. What are the indicators of impairment? So we can say the indicators would be number one, that in terms of the market value of the asset, the market value is significantly decreased. Number two, we can say that there is a adverse impact. There is an adverse impact on business environment, the business environment in which the entity operates. There is an adverse impact, and this would lead to a decrease in the cash flows. Naturally, when there is an adverse impact due to technological environment, legal, political environment, the cash flows might go down. Then we can say that the interest rates have increased. The interest rates go up, and the increase in the interest rate would mean that the discount rate goes up. And when the discount rate goes up, it would imply that the present values will go down, indirectly impacting the cash flows. And the fourth one, we said that the carrying amount of the net assets is more than the market capitalization, is more than the market capitalization. So this is, I think, the summary view in terms of what we've learned on step number one and two. So, what I've exposed you to in this part number one, as I said, we'll be covering the, step number one and two. So I've exposed you to out of the 5-step model on the 2-step. Now with this particular part, you would have got a good input in terms of what is impairment, which assets are being covered under the scope of this Ind AS. We made a 5-step model. Step number one, in terms of looking at the fact, is this asset within the scope of this Ind AS? Yes. Are there indicators of impairment? If yes, please make a formal estimation of the recoverable amount. Do the impairment loss accounting. If there is a U-turn in the indicators, reversal. And finally, disclosure. So we've seen that the scope is comprising of a total of 3 kind of assets: financial, non-financial, inbuilt impairment testing. And I've given you inputs on the indicators of impairment. Though till this particular part there has been no questions in the exam, but I believe, I trust that this is the most important element to understand Ind AS 36. That's all in this particular part, friends. We're going to continue with some more parts coming on this Ind AS with you. That's all for the day. Thank you, take care, and goodbye.